Time Technoplast Limited, 5 years of exceptional returns, continues to be attractive, a leader in polymer technology, in top 3 among global players, diversifying into high margin products, obtains approval for Type 4 cylinders, efficient operations and strong flowback, exceptional performance indicators, trading at a very favorable price earning multiple. A multinational leader over 3 decades of reputation, manufacturing facilities across the globe, operations spread over Middle East, Far East and the US, growing faster in composite cylinders, leading in IBC, earns major revenue from industrial packaging, has a lion's share of domestic market. 5 traditional products in the mix: chemical and food grade packaging, pipe and fittings for infrastructure, crates and bins for logistics, household convenience products, and polymer auto components, a dominant market share in industrial packaging in the country. Actively shifting revenue mix towards high margin composite products as a next generation packaging solution comprising margin rich intermediate bulk containers for liquids and bulk materials, superior margin lightweight composite cylinders, type 4 for CNG and hydrogen, and type 3 for hydrogen cylinders. Has international technical tie-up for world-class technology standards, obtained approval from Indian Petroleum and Explosives Safety Organization, also obtained global testing inspection and certification from Bureau Veritas France, already in receipt of sizable orders for type 4 composite cylinders. Significant rise in profits over last 4 years. FY25 year-on-year growth of 25% on a trailing 12 months basis, profit growth of 20.4% by December 25, improvement in operating margin TTM December 25 up by 30 basis points. Strong and consistent generation from operations, sizable cash generation for FY25. The trend has continued for the 6 months ended September 2025. Efficient working capital management has added to the rising funds from the operations. Free cash flow after investment in fixed assets has remained significantly high. The trend remains unchanged for the first 6 months of the financial year FY26. Average capex of around rupees 180 crores prioritized as per capital allocation plans, renovation and brownfield expansion funding for existing facilities, value added high margin products considered for major greenfield projects, that is for IBCs and composite cylinders. A significant part of investments channelized into automated plastic recycling facility for sustainability and compliance. Strong liquidity from flowback is helping reduce debts with a growing equity and a constantly diminishing non-current liability, as also the growing assets getting funded by flowback. The extent of debt has been quite minimal at hardly 12% of equity. Planned capital allocation and divestment of non-core investment is the spirit behind this strategy. Excess of operational funds after capex funding is helping strengthen equity. The company has matching inflows for meeting its short-term financial commitments. Rising margins and cost savings from power purchase agreement have been special liquidity enablers. Constant margin improvement from product mix and operational efficiency. Profit growth is leading the revenue growth. Return on equity moving higher on a TTM basis, and this is a very positive development. Current valuation of the company quite interesting. A PE multiple which appears quite attractive. Price book ratio closer to 3. Dividend yield on par with the industry. From the current price, substantial upside potential to 52-week high. PE ratio compares well with the peers. As a dominant packaging company, the PE perfectly moves with the packaging industry. The growth potential from hydrogen sector is yet to be built into the projected PE. Price earning growth ratio PEG being below 1 is quite positive. Product diversification and higher margin expectations offer a greater potential to take its prices higher. Slow and steady price movement sideways. Price closer to its 52-week low. Below all averages after the recent fall. RSI indicates oversold position. Bearish pressure have been mounting with offloading by FIIs for profit booking in recent quarters. Historical return of about 350% over 5 years. Promoter stake fall is not due to any sale by promoters but because of the arithmetical adjustment arising out of the recent QIP. A strong earnings growth and cash generation. Market leadership. First mover advantage in the hydrogen segment. Favorable margin position. Value added product mix. And a near debt free status in the balance sheet. Attractive valuation. Consistent profit growth. But faced with the risk of bearish technicals. Crude price impact from geopolitical reasons is the ongoing and immediate risk. Hope the video was to your liking. I am Vittal Prabhu with the fortnightly video on stock learning simplified. Similar quality videos are available for your access at the info card. Looking forward to your feedback and suggestions for improvement. For your kind attention and valuable time, highly obliged. This video is for purposes of information, education and awareness only. This is not meant to be a solicitation or recommendation to buy, sell or hold securities. Wherever applicable, please seek the advice of a competent professional before taking action of any kind.